Welcome to Accounting Actuals. We simplify accounting and bring practical insights on the financial tools that every business needs. There are a few accounting concepts that almost everyone gets wrong, and honestly, they can cost you real money. Today, we are breaking down 3 common misunderstandings: markup versus margin, cash flow versus profit, and the truth about write-offs. These are simple once you understand them. And once you do, you'll look at your business numbers completely differently. Let's make this simple. 1. Markup versus gross profit. They are not the same. All right, first up, markup versus gross profit margin. People use these interchangeably, but they're absolutely not the same. To mark something 50%, you will need to take $100 cost times 50% markup, and you get $150 sale price. To calculate gross profit margin on the sale, you will need to take $150 sales price minus $100 COGS and divide by $150 sales price, and you will get gross profit margin of 33%. So why aren't these two numbers the same? It is because markup is based on cost, but your gross profit margin is based on revenue. Two completely different bases give you two completely different percentages. And here's why this matters. If you set prices based on markup alone, you may think you're getting a healthy margin, when in reality, you might be underpricing your products. This misunderstanding is one of the biggest reasons businesses struggle with profitability. Get this one right, and your pricing strategy becomes instantly more accurate and more profitable. Next one is cash flow versus profit. They are not the same. Profit does not equal cash flow. This confuses so many business owners, and it can be a very expensive misunderstanding. Why is it important to know the difference? Cash flow tracks the actual movement of money in and out of your business. Profit is what shows up on your profit and loss statement, but it doesn't always represent what's in your bank account. Why is it important to draw a distinction between the two? Let's look at an example. Cash flow example. Your business purchases raw materials for $20,000. You record this as inventory on the balance sheet. Because it hasn't been sold yet, it does not hit the profit and loss, so it doesn't reduce your profit. You still spent $20,000 cash. Your bank account went down, while profit and loss profit stayed the same. Meanwhile, profit may include things like depreciation and amortization, which reduce profit but don't use cash. Accrued revenue or expenses, which change profit even if the cash hasn't moved yet. This is why a business can show a profit on paper, but still not have enough money to pay bills, make payroll, or cover taxes. Cash flow tells you whether your business can survive. Profit tells you whether your business is successful. You need both, but never confuse the two. Third, a write-off is not free money. And finally, let's talk about this famous myth. Just write it off. It's free. No, a write-off is not free money. It simply means you can subtract a business expense from your income before calculating taxes. All a write-off does is reduce the amount of tax you owe. Example, you buy a laptop for your business for $1,000. Your tax rate, 20%. Here is what happens. You spend $1,000. That's real money leaving your pocket. Because this is a deductible expense, you save 20% of that on your taxes, so about $200. You spent $1,000, so the laptop actually cost you $800, not zero. A write-off is like a discount on your tax bill, not a free purchase. Was this helpful? Don't forget to subscribe for more business finance tips that actually make sense. Thank you so much for watching. For more information on how we can support your financial goals, be sure to check the details in the description below or visit our page.